Hi, I'm Nick Drew with Capital Design Private Wealth, bringing you our monthly video newsletter. One big thing that you may have heard about in the headlines is the Federal Reserve's hint that it might start tapering soon, and how this could cause a correction or an economic slowdown. Let's discuss. First of all, what does tapering mean? In econ speak, tapering means winding down the pace of the assets the Fed has been buying since last summer. Why is this a big deal? Well, the last time the Fed tapered in 2013 during the recovery from the 2008 financial crisis, markets panicked and pitched a taper tantrum. That's because traders worried that the less Fed support would hurt fundamentals and potentially cause a market downturn. Now that old taper tantrum narrative is making folks worry that another market downturn could be ahead of us, especially with concerns about the Delta variant. Before we dive into what could happen, let's talk about where we are and how we got here. When the pandemic started, the Fed slashed interest rates and began buying $120 billion a month in bonds and mortgage-backed securities to reduce interest rates, lower borrowing costs, and give businesses and the economy a boost. Now that the economy is much stronger, the employment situation has improved, and inflation is a concern, the Fed wants to start paring back those asset purchases to return interest rates to a more natural level. And what could this look like? Obviously, we don't know exactly when or how the Fed will decide to act, but analysts have some pretty good guesses. The latest prediction by Bank of America suggests tapering could start this November as the Fed gradually pares back asset purchases through next year. The takeaway is that the Fed isn't going to stop buying assets and raise interest rates immediately. It's going to gradually remove the support and see how the economy reacts. So, will we see another taper correction? The main reason folks worry about the Fed reducing support is because of the effect higher interest rates could have on stocks, particularly companies that rely on borrowed money. However, interest rates are just one piece of the puzzle. Economic fundamentals, earnings, and other factors also will weigh in on stock prices. With the benefit of hindsight, we can see that the 2013 taper tantrum wasn't even that bad. The S&P 500 tumbled 5.8% over the course of a month, but quickly recovered. The caveat here, of course, is that the past doesn't always predict the future. I think the main reason the markets declined last time was that investors hadn't experienced tapering before. They didn't have context for what the Fed would do. Since this has happened before fairly recently, I think uncertainty has lessened. However, we also have other worries to consider. The crisis in Afghanistan, continued pandemic worries, and political wrangling over infrastructure. Any of these factors could derail the bull market, but it doesn't mean that it's the end of the world. Corrections are always something that we should expect. They happen regularly and are a natural part of markets. According to investment firm Deutsche Bank, the stock market on average has a correction every 357 days, or about once a year. These 10% or more corrections are no fun, but often do not lead to a recession. The Fed is just one more thing that we're keeping an eye on, and we will reach out if there's more you should know. Be well.